I call this hearing to order. As a result of the Great Recession, lending to small firms declined, and only recently have we started to see signs of growth. For small businesses, access to capital is often the deciding factor if a business will expand or close its doors. Since the Small Business Administration's creation over 60 years ago, the agency has been tasked to administer programs that help entrepreneurs receive capital. In doing so, the SBA oversees 4 primary lending programs: the 7A Guaranteed Loan Program, the Certified Development Company Loan Program, the Small Business Investment Company Program, and the Microloan Program. Each of these programs, as we will hear today, serves a unique purpose and aims to fill a gap in the commercial marketplace. Although this is a great oversimplification of the process, the Small Business Administration does not directly provide funds to small businesses through any of these programs. Instead, the administration guarantees the repayment of credit and equity issued by private sector partners. These industry partners are vital to the success of the programs and ensuring that small businesses have access to the capital they need to grow. Today, we are fortunate to have an industry witness here from each program to shed light on the assistance they provide and share with us their thoughts on how they can better their respective programs. I look forward to hearing your recommendations and thank you all for taking the time to be here. I now yield to the ranking member for her opening remarks.
Thank you so much, Mr. Chair. And I thank all the witnesses for being here today. I have been looking forward to this hearing, especially since I know how valuable your programs are. And today's hearing will provide even greater insight into these access to capital programs and what potential improvements could be made to help these initiatives reach their full potential. Our small business sector is back at the heart of job creation after one of the worst economic downturns in history. Small firms with less than 50 employees have averaged 106,000 new jobs per month for more than a year, and that is a good sign. As the economy continues to strengthen, more entrepreneurs will be seeking capital to start a new venture or expand an existing business, and the Small Business Administration's loan programs fill critical gaps in the lending market for small businesses that can't access traditional lending sources. For more than 50 years, the SBA has been assisting America's entrepreneurs and small business owners through a myriad of capital programs, including 7A, 504 CDC, microloans, and the SBIC program. Last year, it channeled more than $30 billion in assistance to over 58,000 small firms under these programs. And for 2015, SBA is on track to provide over $25 billion in capital to small businesses. Each program here fills a distinctive, specific need in the market. The 7A program, SBA's flagship access to capital initiative, has made an impressive $19 billion in capital available to small businesses in 2014. This number has continued to improve over the past few years. However, more must be done to encourage lending the small dollar loans, as well as to increase lending in underserved markets, and particularly for women, minorities, and veterans. Small dollar loans used to account for 25% of all dollars approved, but today that figure is just 10%. The 504 CDC program provides long-term key fixed assets to expand or modernize, such as in real estate, land, or equipment. Since 1990, the program has provided $64 billion through more than 120,000 loans. In my home state of California, 504 loans have added over 500,000 jobs to the economy and benefited over 20,000 entrepreneurs. However, the program faced challenges during the economic downturn to the nature of real estate-heavy programs. Despite these setbacks, the program is recovering, and this year will mark the first time in 7 years that SBA has not requested a subsidy. I hope this upward trend continues, and I look forward to learning more about what changes we can make to ensure the 504 program preserves the 504 CDC economic development mission and increases its lending volume. The microloan program is unique in that it is designed to provide small dollar loans under $50,000 to entrepreneurs that cannot access capital through traditional bank loans, and is required to provide education and training to its borrowers. And often these borrowers are women and minority-owned firms. In 2014, SBA Microloan Intermediaries provided nearly $56 million in microloans to small businesses and created or retained 15,000 jobs. That is a big impact. Additionally, this year, SBA has requested a 30% increase in funding for the Microloan Program, which is expected to support about $75 million in loans to small businesses. However, there are many technical changes that could be made to make the program run more efficiently and allow intermediaries to provide the kind of assistance that borrowers need. And I look forward to hearing more about those changes. And when small businesses are looking for more than a conventional bank loan, but are not yet ready for private equity, they can turn to the Small Business Investment Company program to fulfill their capital needs. In 1958, Congress created the SBIC program to fill this lending gap, and last year alone, the program provided over $5 billion to startups and high-growth companies. The SBIC program faces its own unique set of challenges, such as limits to the amount of leverages available to them, as well as issues with the licensing process for established firms. Whether it's a working capital loan, a mortgage, a microloan, or an equity investment, capital is the lifeblood of every small business. Without it, most firms cannot make the improvements or hire the people that they need to succeed. SBA has been there for thousands of small businesses over the years, and it's the responsibility of the committee to ensure that it continues to operate to its maximum potential. With this in mind, I'm looking forward to hearing from today's witnesses on ways to improving the agency's lending programs. And I'd like to thank all the witnesses for being here today. Thank you, and I yield back.
Thank you, Mrs. Chu. If additional members have an opening statement prepared, I ask they be submitted for the record. I'd also like to take a moment to explain the timing lights to you. You each have 5 minutes to deliver your testimony. The light will start out as green. When you have 1 minute remaining, it'll turn yellow. Finally, it'll turn red at the end of your 5 minutes. I ask that you try to keep it to that time limit, but I'll be a little lenient if you need to close. All right. Our first witness is Rich Bradshaw, who serves as the president of Specialized Lending at United Carolina Bank in Greenville, South Carolina, my home state. Mr. Bradshaw is testifying on behalf of the National Association of Government Guaranteed Lenders at NAGGL, NAGL. Mr. Bradshaw chairs the Public Policy Committee, tracking and assessing SBA's current lending initiatives. Previously, Mr. Bradshaw served in the United States Air Force and Navy, and I want to thank you for your service to our country. We look forward to hearing your testimony. Please begin.
Good morning, Chairman Rice, Ranking Member Chu, and distinguished members of this subcommittee. I'm grateful to have this opportunity to testify before you and discuss the impact of the Small Business Administration's 7A program on both lenders and the small business community. As Chairman Rice said, my name is Rich Bradshaw, United Community Bank. I'm the president of Specialized Lending. We're headquartered out of Blairsville, Georgia, and I work out of the regional headquarters in beautiful Greenville, South Carolina, and also representing NAGL, which is the SBA 7A Trade Association. I've had the unique experience of running SBA divisions at very large national institutions as well as community banks, and I'm also a proud veteran. Let me give you an example of why I think the 7A program exists. If you're a manufacturer and you're doing about $3 million in annual revenue and you have 25 employees and you're looking to buy a new CNC lathe, it's going to run you about $400,000. Conventional financing, we're going to set the interest rate at 6%. It's typically going to be 5 years in terms of the term. Under the SBA, we'll have that same interest rate, but it'll be 15 years. The cash flow savings for that borrower will be in excess of $50,000. Now, I know in Washington, $50,000 is not a lot of money, but to a company doing $3 million in revenue, it's all the money in the world. And it allows that owner to focus on margins and market share and hiring that next employee and not being so concerned about making payroll on Friday. And I think that's really the strength of the program. To put it simply, think about your main streets back home. How difficult is it for your small businesses and your constituents to get these loans in a heavily regulated environment, especially given the post-2007 era that we find ourselves in. I'm sure that you all hear this all the time in your districts. The 7A program annually supports over 45,000 small businesses. These 45,000 small businesses take their loans and are able to hire an additional 500,000 people on an annual basis. It's also important to note at this time that the 7A program does not cost the taxpayers anything. It's a very important point. In addition, since 2010, the program has returned over $500 million to the Treasury. Quite frankly, in the current financial climate, the SBA loan programs are the only game in town for long-term financing on any kind of interest rate or terms that would be acceptable to a small business. So what's the one thing that Congress can do to help the 7A program run more effectively and touch more small businesses? It's make sure that we don't shut down. It sounds simple, I know, but it's a looming threat we faced last year and we face again this upcoming year and the year after. Potential shutdown of the programs happens because we constantly lend up to the authorized spending cap. This is a good problem to have. It means small businesses are obtaining capital and the program is working. But as the bank executive who gets to speak to our board on the updates on the SBA division, it's very difficult to discuss the running out of funding concept. It's also very difficult to discuss that with our borrowers. And we want and need private institutions' support to reach more small businesses, and they need to know that Washington's behind them. They need to know that you're behind them. As members of Congress, you are probably all too familiar with having to explain to constituents the ups and downs of funding in Washington. Well, I want you to know as a 7A lender, I'm there with you every day, and I'm having to do that as well. And I know we have that experience in common. For fiscal year 2015, the current authorization is $18.75 billion, but we project finishing fiscal year 2015 around $20.5 billion. If Congress does not act now, we will simply stop SBA lending potentially in the August timeframe. If you're asking yourself why this program is going so quickly, think back to your constituents back home and some of the challenges they run in obtaining capital and hearing the word no from the conventional lenders because it's just too risky for them and because the profiles of the banks have changed since the 2007 recession. What this results in is the boxing out in the bulk of small business in terms of getting and obtaining long-term financing. And if we don't keep running into this problem, it's important to make sure that fiscal year 16 is also properly funded. The President's request for the 7A program for 16 was $21 billion. NAGLE forecasts the industry will lend up to $23 billion in fiscal year 16. Our ask is that the House and Senate Small Business Committee authorize with the Appropriations Committee $23 billion. I also want to, in closing, make sure that the committee understands that NAGLE is very focused on the underserved markets. I co-chair the Public Policy Program. In fiscal year 12 to 15, African American lending was up 93%. In the same periods for veterans, it was up 88%. I have been the leader in terms of growing the initiatives within NAGLE and have a great committee that we work with, really focusing on veteran initiatives. And with that, I'll thank you for letting me speak and open it up for any questions.
Thank you, sir. We'll have questions after everybody has testified. Our next witness is Barbara Vorzek, who serves as the President and CEO. It says, I'm kidding her. Who serves as the President and CEO of the National Association of Development Companies, NADCO. NADCO represents SBA certified development companies and other lenders which deliver SBA loans and financing for small businesses. Thank you for being here today. You have 5 minutes and you may begin.
Chairman Rice, Ranking Member Chairman Rice, Ranking Member Chu, and other distinguished members of the committee, thank you for inviting me to testify, and I look forward to an exchange of ideas today with you on ways we can work together. My name is Barbara Vorzek, and I serve as President and CEO of the National Association of Development Companies, aka NADCO, and we represent more than 90% of the 263 certified development companies, also known as CDCs. These CDCs are mostly nonprofit entities that provide small businesses with the 504 loan program, while often also participating in other federal, state, and local economic development programs. This is familiar territory for me. I founded and ran California statewide CDC for over 21 years. The 504 loan program is a financing tool for economic development and provides small businesses, as Ranking Chair said, with long-term fixed-rate loans to help them acquire equipment. And so that I don't have to restate, which you also said, and I appreciate that last year we did, since 1990, we have provided $64.3 billion in financing, over 120,000 loans. So by law, and the reason that we are really here is we are here to create jobs, and we have to create one job per 65,000, or we have to meet a public policy goal, and we have several. Economic development is the watchword, though, for many of NADCO's members. While 504 was designed to be the larger SBA loan and have a strong community impact, many CDCs also serve entrepreneurs who need smaller loans through programs such as the SBA's Community Advantage Pilot Program, which provides loans under $250,000, and SBA's Microlending Program, which provides loans under $50,000. Incubators, CDFIs, and EDA revolving loan funds are all represented by multiple CDCs in our community. And these are just a sample of the broader work that's being done by CDCs nationwide. However, it is the 504 loan program that unites us all. The program has had, as was previously mentioned, challenging years, as many others did during the Great Recession. But I am pleased to report, as you all know, that we will be back to zero subsidies, self-funded with no appropriation, October 1st of this year. I recommend that during the 114th Congress, the subcommittee focus on several long-term modifications, as well as some immediate fixes to a few current challenges that the industry and the program face. First, the 504 program lacks definition. It is SBA's economic development loan program, and CDCs are economic development entities. However, no definition is currently in statute or regulation for the economic development or CDC. I recommend that we work together, as we've been doing with SBA, to formalize these and other definitions so that there are clear metrics for the program to fulfill its mission. Second, on the list of long-term program modifications, I recommend that the successful debt refinancing with the 504 loan program be restarted permanently. This temporary refinance program made available to small businesses precious working capital, which otherwise would have been spent on either high interest rates or, worse yet, balloon payments. This request is quite timely as well. Over 4,000 small balance commercial mortgage-backed security loans will mature in the next 3 years. Borrowers will need to refinance out of what is being called the wall of maturities. Yet many banks that handled small balance loans prior to the financial crisis are no longer in the market or in business. This is a gap for small businesses that could be filled by this debt refinancing program. Third and finally, the franchise agreements review process needs to be addressed. NADCO recommends that SBA adopt procedures to streamline the review and approval of franchise and license agreements. While these long-term challenges will strengthen the 504 program for future small business borrowers, several pressing matters are preventing CDCs from best serving their communities today. The first is that of adequate levels of staffing at SBA. Recent retirements and other departures mean that a single SBA staff member may be handling the work of 2, 3, or even more personnel. This scarcity slows our ability to support small business entrepreneurs seeking 504 loans and increases the concern and lack of confidence within the small business and banking community about our ability to deliver loans in a timely fashion. We hope this subcommittee advocates for adequate resources through the budget and appropriations process for SBA to manage this situation. The other challenge which concerns the industry and it's taking me over 5, is a move by some in Congress to institute fair value accounting. If the Small Business Committee is consulted on these budgetary changes, I urge you to oppose them. Thank you again for the opportunity to share NATCO's thoughts, and I look forward to your questions and a vibrant discussion about America's entrepreneurs.
Thank you. Our next witness is Brett Palmer, who serves as the president of the Small Business Investor Alliance. The SBIA is a national organization of middle market funds, lower middle market funds, and investors, primarily small business investment companies, whose members provide capital to small businesses. Welcome, Mr. Palmer. You may begin.
Good morning, Chairman Rice, Ranking Member Chu, and members of the House Small Business Subcommittee on Economic Growth, Tax, and Capital Access. Thank you for holding this hearing today to examine the effectiveness of the capital access programs, including the Small Business Investment Company debenture program. The Small Business Investor Alliance represents investors in domestic small business, including nearly all of the SBICs. I would like to make several points with my testimony. First, the SBIC program is an effective and important program for enhancing access to capital for domestic small businesses. Second, the SBIC program works primarily because at its core it is a market-driven effort that serves the public by growing domestic small business and does so while operating a zero subsidy. Legislation to increase the family of funds limit is the most important issue facing us today, and we encourage you to pass it immediately. To the co-sponsors of the bill, many of whom are here today, thank you for supporting H.R. 1023. Its passage will ensure that the best small business investors will continue to invest and grow domestic small businesses. Improvements can be made to the SBIC program because it is operating in a way that is certainly adequate, but there is a lot of room for improvement, and more improvement can help us serve more small businesses and more people in this country. The SBIC program exists because structurally what was true in 1958 is still true today. It is much harder for small businesses to access capital than it is for their larger brethren. That will always be true. The SBIC program helps mitigate this. It will never replace that problem and fix that problem entirely, but it helps significantly. The importance of SBIC capital was made abundantly clear in the financial crisis and the recession that followed. While most financial institutions were cutting off capital to small business and recalling loans, SBICs were throttling up and filling the capital void. Demand for capital from SBICs has grown dramatically since the financial crisis and continues to grow. From fiscal year 2011 to present, SBICs have made $17 billion in investments in about 5,500 small businesses in nearly every state. This activity saved businesses and grew jobs. In 2004, the SBIC program had only about $5 billion in assets. Today, it has grown to over $21 billion. Not only did the debenture program not take losses during the time of economic turmoil, it ran a small surplus. In the face of economic calamity, this program worked both for small businesses and the taxpayers. This growth is not driven by government directive, but by the market needs of small businesses and the opportunities being recognized by private investors. These investments do create jobs, and lots of them. A recent Pepperdine study found that private equity-backed businesses grew jobs at a rate 257% faster than the economy at large. We need more of that. With the continued support of Congress, the administration, and the private sector, this program will continue to grow and serve more small businesses and create more jobs. The program works differently than many other programs. To become an SBIC, a potential SBIC must pass two important filters, and they are both critical. The first one is the private market filter. If the private sector won't trust a fund manager with their money, why should the SBA? It shouldn't. But if they are able to raise that private capital, then they must survive a rigorous licensing process that the SBA runs, and many applicants cannot get through this process. Only about 25% of the funds that first approach the SBA about forming an SBIC are able to get through the process. Assuming they are able to get through the private sector filter and get through the government filter, they are able to access an SBA-backed credit facility, able to lever the fund at a 2-to-1 ratio. So what that does is it takes $50 million in private capital and turns it into $150 million of small business capital at no cost to the taxpayer. Unlike many other government programs that I know of, there is no guarantee on any of the individual investments. In fact, the private sector is at first loss position for all the investments. SBA guarantees the investors in the credit facility, but not the SBIC or its individual investment. This means that there is 100% private sector skin in the game, and the interests of the private sector and the public protections are aligned. This is a key reason why the debenture program has gone so many years running at a small surplus and maintaining a zero subsidy. The family of funds limit is important to us in this program because the family of funds limit only limits successful small business investors. The only funds that can hit the limit are funds that have repeatedly come back as SBIC funds in raising private capital money and going through the licensing process. Underperforming funds cannot hit this limit because they cannot raise another fund. We ask that you pass H.R. 1023 to raise this limit to make sure that the successful small business investors can continue to do so. There are a number of improvements that the program needs. There are a lot of good things that are happening, but there are some improvements, too, that are needed. The licensing process is extremely slow and it's expensive. We have testified for years the licensing process blocks qualified applicants and unnecessarily limits diversity in the program, both geographic and other diversity forms. We ask for your help in pushing the SBA to reform its licensing process and speeding it up and making it less expensive. In summary, the SBIC program is working and working well. Raising the family of funds limit will increase small business investing and help many small businesses grow and access more capital. And SBA needs more operational oversight to help make needed reforms. And with that, I turn back the floor and I would be open to any questions you might have.
Thank you, Mr. Palmer. I now yield to Ranking Member Chu to introduce her witness.
It's my pleasure to introduce Mr. Brandon Napoli, who is joining us today all the way from Van Nuys, California, Southern California, my area. Mr. Napoli serves as the Director of Microlending for Valley Economic Development Center, or the VEDC, and is here to testify about his experience with the SBA Microloan Program. VEDC is an SBA microloan intermediary, and it was named one of the top 10 SBA intermediaries in the country, approving over $1 million in microloans for 2014. Prior to joining VEDC, Mr. Napoli served as a Community Loan Program Officer at the CDC Small Business Finance in San Diego, California. He's a graduate of Point Loma Nazarene University and San Diego State University. Welcome, Mr. Napoli.
Chairman Rice and Ranking Member Chu and members of the subcommittee, thank you for the opportunity to submit testimony about a crucial component of a vital American business community. My name is Brandon Napoli. I'm the Director of Microlending at VEDC, located in Los Angeles. We are one of the nation's largest SBA microlenders. We provide real money to real people, creating real jobs. Microlending is foundational to the economy, and VEDC is committed to helping entrepreneurs like Maria Martir secure microloans to foster healthy, sustainable communities. Ms. Martir had saved $40,000 to launch a business, but her request for a $10,000 loan was declined by local traditional lenders because of no outside collateral or existing cash flow. Ms. Martir turned to VEDC, who offers access to capital as well as free technical assistance for entrepreneurs unable to secure traditional bank financing. 3 years after receiving a $10,000 loan and help with writing her business plan, Ms. Martir's De Todo Un Poquito Cafe, a little of everything, has expanded next door, hired on her 4 children, and is now looking to expand elsewhere. Her experience illustrates what we in the industry have known from years of experience. Hands-on technical assistance, coupled with need-based financing, greatly increases a small business's chance of success. Microlending reaches entrepreneurs who are outside the economic mainstream, but very much a part of the economic fabric of this country. Ms. Martir's Cafe is one of 25 million businesses, or 88% of all businesses in the United States, considered a micro-business, a business with 5 or fewer employees and less than $50,000 in startup capital. These businesses generate $2.4 trillion in receipts, account for 17% of U.S. GDP, and employ more than 31 million Americans. Microbusinesses are everywhere. The farmer at the Saturday market, the trucker who works those long hours on the road, the contractor who built your home, the beauty salon or barber shop, your favorite neighborhood restaurant that you always want them to commercialize that barbecue sauce, and the miniature golf course you worked at as a kid. Think of the business you frequent, and I'm sure that you can encounter many micro-businesses you call your own. Ms. Martir's De Todo Un Poquito Cafe and other microloan businesses could not do what they do without the support they get from SBA microloan intermediaries, such as VEDC. Since 1998, VEDC has lent over $11 million and 1,000 SBA microloans. Thankfully, there are many other like VEDC around the country. For example, the Economic and Community Development Institute in Ohio that provide a one-stop shop where a business owner can secure flexible financing as well as individual business assistance throughout the life of the loan. The proposed fiscal year 2016 budget provides continued opportunities for American entrepreneurs to start their own business and become successful, independent, and self-reliant. To keep the American dream a reality for millions of micro businesses, Congress needs to increase the effective investment it has made in SBA microloan from $24.8 million to $28.3 million and make the programmatic changes suggested by the current intermediary micro lenders. Increasing lending and easing some of the SBA microloan program restrictions will help to further the American dream, one microloan business at a time. Since the microloan program was authorized in 1991, intermediary lenders have borrowed over $414 million, of which they've been able to lend $629 million to small businesses that have helped create or retain 185,000 jobs at the cost to the federal government of around $2,000 per job. During this time, and since the launch of the SBA microloan program, intermediaries have realized that the several well-intentioned policies that now serve as barriers to gains and efficiencies. The most restrictive barrier is the statutory restraint of utilizing 75% of the technical assistance post-funding and to only 25% pre-funding. As with Ms. Martyr and the majority of micro enterprises, the need for intense technical assistance before receiving financing ensures that the small business is loan ready. In closing, every day, VDC and microloan lenders across America see hardworking people like Ms. Martyr who want to and can build businesses, create jobs, and strengthen communities. The greatest investment we can make is in people who create jobs. The returns go far beyond the dollars paid back. Thank you for this opportunity to share Ms. Martyr's and industry story, and I look forward to your continued support of the programs designed to promote job creation, especially those with proven track records, such as the Microloan Program at SBA.
Thank you, Mr. Napoli. I have a lot of questions for you, but I want to start out by saying that, in my opinion, there's nothing more important than American competitiveness and jobs. We can't have a strong country without a strong economy. And I think you guys are on the front lines, and I can't thank you enough for what you do providing access to capital. I think that is one of the foundations, one of the bricks in the foundation of the prosperity of this country. And I'm so impressed listening to how you perform your duties and how you grow jobs in this country. I have so many questions with respect to what areas, where are the gaps here that are not being filled? You know, you have microloans, you have the 7A loans, you have the CDC, SBIC. Who's falling through the cracks here? Sounds like you've got the small business area pretty well covered. Are there broad classes that are not being covered? Mr. Palmer, I'll start with you.
Sure. I think that one of the classes that is not being covered and not really discussed is the early stage equity side. A lot of businesses to start up that are smaller businesses that aren't necessarily tech and biotech in Silicon Valley really do have a real challenge in figuring out how to get early stage equity investing when you're not cash flowing and you're not going to be cash flowing in the very near term to pay an interest payment on a debt structure. So I think that is an area that really is lacking in the economy right now.
Mrs. Vorchak, you said something that intrigued me earlier. You said we need to restart the refinance program.
Oh, thank you.
You said you thought we needed to restart the refinance program, and why did you say that?
There are a couple of reasons, but the large reason coming is what's known as the wall of maturities. So these small balance loans that were done prior to the recession, a lot of small businesses are in these pools and these mortgage-backed securities. And so as they mature and they come out of the pool, then the houses, the larger investment houses, don't do loans under $2.5 million. And so there's all of these owner-user small business types coming out of that, having to come up with other financial instruments.
Well, so there were commercial lenders that made these loans before the financial crisis.
They were actually pooled loans, so Wall Street firms would typically be involved. Some of them, I mean, Chase is in the room, and they act on both sides. So you have a lot of banks that also have investment houses as well.
Here's my question. Certainly things were out of hand before the financial crisis, and certainly there needed to be some additional safeguards but have we snapped back so far that we have taken lenders out of the market that were previously providing this financing? And can the SBA ever, because I don't think they can they ever respond to that demand?
Oh, boy, I'm not sure I'm trying to understand the question. For some reason, I was kind of caught with the walls of maturity thinking of these coming out. The comment we made, and I made about as these loans come to market, as you know, the shrinkage in the number of community banks that are now alive and well versus who they were back in 07, 08, we've had a shrinkage in numbers of community banks. And very often, the borrowers would look to their community bank to refinance. Those would be where they would typically go.
I agree that
Yeah.
we've had a huge shrinkage. Mr. Bradshaw, I'm going to turn to you. I agree we've had a large shrinkage in community banks, and I think a lot of that is because we've snapped back too far with regulation. And what I'm concerned with, Mr. Bradshaw, do you think that the SBA can ever fill that niche completely, or do you think we need to expand, to do what we can to ease the regulation on community banks and get them back into the market?
I think the answer is probably yes, partially yes on both sides, meaning can SBA help fill the gap? Yes. Can it fill it all the way? No, but a combination of SBA and a combination of less regulation can get us a long ways there.
Mr. Palmer?
The private sector can fill a lot of gaps that we can't. And the SBA is really meant to fill areas where the private sector can't fill the gap, but where there's a public policy need. The banks, particularly the smaller banks, are feeling all sorts of pressure that really is hindering their lending. They're not something that we compete with. We actually augment a lot of the banks. But I think that is an area. Certainly there is need for regulation, don't get me wrong, but I do think that the banks that I talk to, and I hear from anecdotally, feel there's a lot of pressure that's hindering them from doing small business lending that they otherwise would do.
Mr. Napoli, I don't know that this is really in your area of expertise, but I want to ask you the same question.
Can you repeat the question?
My time's expired. Thank you very much. I'll yield to Mrs. Chu for her question.
Well, thank you. And I feel the same as Chairman Rice in terms of all that you're doing for the small business community in providing them the access to capital. And I'm intrigued by your recommendations for improvement. And I'll start with you, Ms. Vorsek. Last week, I introduced the CREED Act, which would reinstate SBA's 504 refinancing program. The President has supported this initiative in his budget. The SBA administrator has spoken favorably of the program, and the Senate has marked up their version of the CREED Act with bipartisan support from the chairman and ranking member. Do you believe the reauthorization of the 504 refinancing program would be beneficial for the small business economy? And some believe that, we're already in the recovery period. But can you tell us why right now actually is an optimal time to restart the debt refinancing program?
Well, first of all, let me thank you for introducing the CREED Act. The industry is very thankful for that. I think it's a good time. I mentioned the walls of security of maturities that's coming up, and that would be an opportunity to help small businesses that are coming out of that looking for alternative financing by providing them with refinancing under the 504 program. I also believe that the 504 program is a very efficient way to refinance, and I think it's good for the banks, and I'll tell you why. When you refinance a 504, a situation where it's a 504 refi, the bank may be involved and they continue to be involved. So they're not taken out by another bank. So it's an opportunity for many banks and often community banks to keep their customer, and then we do the second mortgage because our loan is always in companion with a first mortgage lender. And so it's often, this is a relationship that the lender has, and we're coming in to accommodate them up to a 90% loan to value, which, Chairman Rice, I apologize. I think I now understand your question, and I guess what I would echo in here, but also state that I think that I am a director of community bank, and I would say that the guarantee, whether it's a 504 second mortgage or a 7A, allows us to do loans that we otherwise would not be able to do. So it's absolutely a critical product, particularly now with all of the regulation that has fallen on the smaller banks. We are looking for opportunities. So back to, I'm sorry, Ranking Member, I wanted to get back to your question, but there's a great need out there for the ability to take advantage of the low rates. We see it across the board in housing right now, so homeowners can lower their rate. And it seems, and in many different cases, it's allowing them to get the working capital when we speak about small businesses for growth. And that was alluded to, Mr. Bradshaw alluded to the need for working capital and how businesses, that $50,000 that was saved on that $400,000 equipment loan, when we refi and you look at the cost savings and you bring them into a low-cost interest, the first mortgage will be lower, our second mortgage will be a lower interest rate. The savings over time provides that business the opportunity to invest in jobs, inventory, and growth.
Okay. Well, thank you. Mr. Napoli, I was impressed by the success of the Microloan Program, and you emphasized this issue regarding technical assistance, this requirement that only 25% can be used prior to the loan. Why do you believe that this should be changed?
Thank you for the question. Since the creation of the program back in '91, a lot has changed. Microlenders now are not just microlenders. They also offer other types of technical assistance, or an SBA 7A loan, a 504 loan. A lot of times a client comes in, and through that SBA technical assistance, we find that there might be a better fit for another product. And so we only give them the pre-loan technical assistance. Another thing is, a lot of times when a client comes to us, they don't have a money problem at first. They have an idea problem. And so to be able to front load a lot more technical assistance in the front end and deal with that idea problem, like creating a business plan or helping them with lease negotiation or working with marketing, instead of trying to get them through the process quickly and get them a loan so then we can give them more technical assistance, will allow us to be able to really foster that time with the client before they just get the loan and go forward. Overall, just more flexibility and technical assistance would allow the intermediary, which has proven over the last 20 years, that they're able to serve their clients with customized technical assistance in their local communities.
And also, intermediaries are limited to no more than 25% contracting out. And you think that this should be changed. Why is that?
That's correct. Right now, the SBA says that we can only use 25% of our TA dollars for contractors, and that poses two limitations. The first is it's hard to recruit talent outside of my staff. So if I need to get a CPA or a lawyer or someone that has specific technical experience, overall I'm limited to 25% of my money being used for those contractors. Additionally, if I want to expand into local markets and I want to have someone with a local presence there, again, I'm limited by the fact that I can only do that with 25% of my dollars.
Thank you. I yield back.
Now I yield to the chairman of the full committee, Mr. Shabbat.
Thank you, Mr. Chairman, and let me begin by thanking you, Mr. Chairman, and the ranking member, Ms. Chu, and the other members for attending this hearing, and especially the witnesses for being here today. I think we all know that access to capital is one of the most critical challenges that's faced by small businesses in today's environment. It's been the case in the past, probably will be in the future, but it's really important, and so addressing this in this hearing, I think, is quite important, so thank you. I just have two questions, and first of all, Mr. Palmer, I'll begin with you if I can. I recently introduced H.R. 1023, the Small Business Investment Company Capital Act of 2015, which would increase the amount of capital available to small businesses by raising the family of funds cap from $225 million to $350 million. Do you have any data on the effect that this would have on small business lending, and just anything you'd like to say about that legislation? We'd be happy to hear.
Well, Mr. Chairman Shabbat, thank you first and foremost for your support of that legislation and your leadership in this committee. I'd also like to thank Congressman Hanna and Congresswoman Chu, who are co-sponsors of that bill. We have a number of funds that are slamming into that ceiling, and there are a number of funds that are going to hit the ceiling that may not be apparent that they're going to hit it yet, because they know it, but it isn't necessarily showing them the data, because they're long-term investors. So their current fund, they may not be at the limit, but as they're planning their next fund, they know they're going to slam into it, and they're considering whether or not they're going to do a small business fund. So I think that once this gets up and running, I think it'll be an increase of between $500 and $750 million a year in small business investing. Market conditions will dictate that, but that's a significant increase in small business capital that's out there at zero cost to the taxpayer.
Okay. Thank you very much. And my second question, Mr. Bradshaw, I'd like to get at you if I can. Thank you, first of all, for your service to our country. We greatly appreciate that. I'm planning to introduce a bill shortly that would statutorily eliminate the origination fees on 7A loans, the express loans to veterans. As you know, SBA is already doing this through the administrator's discretion at no cost to taxpayers. Can you discuss the 7A expense loan program and how this fee waiver benefits veteran entrepreneurs?
Sure, and thank you for the support of this, Chairman Shabbat. This is veterans are my passion, and just for the committee, I brought our brochure that we do. I know it's a long ways to see, but we do this and we work together as a committee within NAGLE. We compete with each other every day, and so we're always trying to take deals away from each other. In terms of veterans, we actually share our marketing ideas, and we work together, and we electronically send things like this around. And I said, speaking with some of you before, last time I sent this around, I had a person call me and said, I really, really like this. Is it all right if I copy it? I said, absolutely, but you may want to change the phone number. So anyways, thank you for the support of the veterans. I've been representing NAGLE, very vocal on that from day one, because several years ago, it was one of the biggest initiatives of SBA was the veteran push. And I was always, well, if we're going to have a veteran push, shouldn't we reduce the fees? And we take this very seriously in NAGLE and the institution I run. The fees have really made a difference, and sometimes it's momentum. It's been very recent. This year has been the biggest year in my institution, and
really supporting our small businesses, helping our economy, getting people hired. It really is so critical. So, and I appreciated all your testimony this morning. Last August, I held a roundtable with a lot of local women business owners in a waffle shop in San Pedro. It was a great morning, and while I'm always impressed to hear, like, the 7A program, we're up in lending by, I think, for loans under $150,000, up by 23%. I mean, we're hearing all these great stories about how more capital is getting to our small businesses. But I got to tell you, almost every one of those women owners that came that morning, continued to complain a little bit about always being denied some of these by banks for some of these 7A loans. And still, probably one of the biggest complaints I get from my small businesses in my district is still a difficulty. There's a disconnect on getting some of this capital to our small businesses. So I was going to ask Mr. Bradshaw, if you could, do you have a sense of what are some of the reasons that lenders decide that a small business is not worth the risk? What would those be, and how can we maybe fix that?
I think the challenge when people look at a small business conventionally, probably the biggest challenge is collateral. So that's probably number one. And then number two is traditional conventional lending has shorter terms, and those shorter terms don't allow the loan to meet bank debt service requirements because it's just a shorter term. You're thinking about buying a car on 5 years versus 10 years. The financials don't work for the company to do it on 5 years where they would on 10 years. And I think those are the biggest impediments.
Do any of the other witnesses have any comment on why you think some of our small business, particularly our women-owned, minority-owned businesses, sometimes fall through that crack that we were talking about of being, not a good risk?
Well, I would say that it's a bit out of my wheelhouse as representing the 504 industry, although a number of our members do a great deal of technical assistance. I think that the reality of banking these days is that they simply don't have the time to invest in what needs to happen with a small business in order to make them capital ready. Mr. Napoli actually brought up a very good point. I was applauding over on my side that much of the work needs to happen before the loan. And so there are networks like the SBDC network SCORE that can help borrowers, and including the micro-lending network and community advantage network that actually work more intensively. I would say that I don't know the women you met with, but I would probably look at, speak with them about, where they are on the capital readiness. I mean, you're really looking at the continuum of capital readiness sitting at the table, but I think a lot of it is how they're queuing it up, meaning how they put together their request for funding and whether they qualify for conventional. And then as you go to SBA, there's obviously a greater tolerance for no collateral or high loan-to-value situations. But a lot of small entrepreneurs and businesses, they simply need hands-on in order for them to be able to get to the capital point.
Right. Thank you. And Mr. Napoli, I would follow up with what you were talking about, how you offer this kind of assistant, right, helping writing business plans, finding ways to finance businesses that have been considered unbankable. Do you believe that model could also be expanded to assist small businesses that are being denied these 7A loans so that they could also get this kind of financing?
Absolutely, and to go back to your original question, I know over 60% of my portfolio is made up by women and minority. So I think what micro loans do very well is actually reach out to those communities and allow them to feel welcomed into the process. And one of the things is the technical assistance that we do provide from a gamut of different services that could completely be relevant to a more upstream 7A lending as well. What I find is borrowers are very competent at making widgets or doing exactly what they know to do, but they do have blind spots. I even have my own MBA, and as I was discussing yesterday, I would be frightened to start my own business because I didn't do so well in my accounting class. And so I think, when talking to business owners at any level, technical assistance is something that is absolutely necessary for them to become more successful.
Thank you. Mr. Chairman, I yield back.
I now yield to the very learned chairman of the Contracting and Workforce Subcommittee, Mr. Hanna.
Hey, thanks. Mr. Napoli, changing the 2575 rule, I want to ask Mr. Bradshaw about Dodd-Frank and commercial banking and how that's changed the nature of, and you mentioned mortgage-backed securities, the wall of loans. I mean, if you never pay anybody back, basically you never default, which is, I'm concerned about the wall of loans. But Mr. Napoli, how would you recapture that money if you were to change this or eliminate it altogether? Because what you say makes perfect sense, that people need a lot of technical assistance. They have a great idea, but no basic skill set to do this. What would that look like, though, and what would it cost? Because basically you're upfronting money before you make a loan, and you may decide otherwise. So how do you navigate that?
That's a great question. I think one way you obviously navigate it is through looking at the portfolio's performance of what we've already done, and trusting in these microloan intermediaries that they're going to make the right decisions from the years of experience. And also you incentivize them to continue to stay loan-centric in their lending, so they're not just offering technical assistance.
So what you're saying is that we should allow the subjective nature of the process in the people in the know to take advantage of that, their knowledge, their interaction with people, and give them more latitude in that ratio of 25-75 in TA assistance.
That's correct.
Mr. Bradshaw, thank you. That's helpful, because I believe that makes sense to me. I just don't know what it would cost. Mr. Bradshaw, talk to me if you can, because you've mentioned, inferred a couple times about commercial banks and how they've changed and how they've walked away a little bit, for lack, that's my words. How did that play out, and why did it make what you're doing more important?
Well, I think, as we're all aware, with the recession, and part of the recession that came was banks became more conservative, credit became tighter to get. In addition, we became a little more heavily regulated. And you mentioned Dodd-Frank, that's been part of it. And it's not just been in addition to someone looking over our shoulders, there's been a real cost associated with that too, meaning you have to hire more compliance officers, you have to hire more bank security officers. There's been a real cost associated with that. And that, I think that's just continued to add to tightening the credit market. And one aspect that does help from this, from the SBA standpoint, is the SBA loans take less capital. And so by applying SBA loans, banks can take advantage of that attribute, that they're not using as much capital and they're not running into the capital requirements under Dodd-Frank and other regulatory requirements.
Everybody here has referenced the fact uniformly that the default rate is really, really low, which makes you feel good about the process. And it makes people want to raise the limit because what the hell, there's no risk, associated risk, right? We know that's not true, but because there has to be. But and I could answer the question, why have a limit at all? But could you talk to me about this mortgage wall or this lending wall, Ms. Forzak? Because it's interesting to me, because implicit in that is that there are people who will default if they're pushed up against that wall without the extension. Is that fair?
What would happen, just as for the sake of this discussion, let's say you have an owner-user small business borrower in there that was financed through one of these security pools, and they're coming out with a $2 million balloon. And it's very tough to finance a $2 million balloon payment. Basically, you're looking to refi, so you're coming into the commercial market or the SBA market saying, I need to refinance this $2 million balloon.
And how long have they been in business, do you think?
You know, that would require that I would know what was sitting in those mortgage-backed pools back in 05, 04. You know, I would imagine that if they got into the pool in the first place, my guess would be that they were a relatively seasoned business, because in the pooling process they would be vetting. If it were an owner-user, they would vet that.
That's helpful. So if they're a relatively seasoned business, they took out a balloon mortgage, which can be foolish on its face, right? They knew that. They're facing that. They're a relatively mature business. What do they need with us?
When what was available to them in 05, let's say, for instance, they were financed in 05, they're upside down on that commercial building in Brooklyn. Well, maybe not Brooklyn. Maybe they're upside down in that commercial building in Oklahoma City, or, you know, wherever things flipped. And California was one of them, but we're recovering. So their loan to value is compromised, or they're at 90% if they try to get $2 million, whereas under a normal amortization, they may have been at 70, which would be financeable pretty easily through the banking markets. But 90 is absolutely an SBA product. And so I want to differentiate. In SBA lending under our program, the 504, we are looking to provide working capital, free up working capital for these businesses to grow. And in the case of refinance, this is so that they have the funds in order to expand their business and not be taken down by the inability to get a 90% loan to value. We are not looking at businesses that, if they had the financing available, would default. We're looking at a market gap. And so these could be healthy businesses coming out, but they're still at a high loan to value.
Thank you. That clarifies everything for me, because really you're not trying to push out the inevitable. What you're trying to do is help people who inevitably will succeed, in your view.
And to remember that there have been many times in our history in lending where balloon payments were absolutely the market. When I first started in the 80s, 5-year mini perms was kind of a standard on commercial product, and it then stretched to 10. Even to get banks to go to 10 years, given capital requirements and liquidity issues, 10 years can be tough. So it just depends where we are in the market in lending.
My time's way over. I thank the Chairman for the indulgence. Thank
I
you.
apologize.
Oh, no, it's my fault. Thanks.
I want to ask just a couple more questions. Mrs. Vorjak, this wall of refis is just a curious thing. Is a part of that because the capacity of lending has declined? As you know, we're hearing community banks, there are fewer community banks today than there were 8 years ago. And there's also, for the first time in 70 years, over the last 7 years, there's been less business startups than there have been businesses going out of business. And I'm not sure that those things aren't very closely related, because access to capital is one of the keys to our competitiveness. So what I'm asking you, because I'm concerned that the SBA, although you're doing great work, can never fill the void, that commercial lending is going to have to be where this solution is found. Do you think it's because of lack of capacity? Has the pendulum swung too far? And are we regulating these community business banks out of business, and therefore we have this wall of refis coming that presents this big problem?
I think that things have swung quite to the opposite direction, as has been mentioned several times. It's costly to run a bank now. I don't care if you're large or small, with all the regulations and really, things that are in place that they want to avoid another disaster. I understand why they're there, but as you said, the swing is quite strong. Can SBA fill the gap? When you're looking at programs, at least 3 of the 4 here that are paying for themselves through a zero appropriation, it's a heck of a deal for the taxpayer and for our communities, as we are at zero subsidy. And so, yes, we're filling a really important gap, and as you have seen in the 7A program, the growth is there. And in 504, we've been a little challenged, and we'll come back roaring, but, we've had times right now that our volume is not as high as it could be, but we still are zero subsidy. And so we fill a gap, and we fill a gap at no cost to the taxpayer. And so for that reason, I would say that we can grow and we can be important to fill what you're speaking about.
Mr. Palmer?
I guess what I'd add to that is, Dodd-Frank existed because we clearly had gotten, overboard, and there were real problems that had to be addressed. But one of the challenges with Dodd-Frank is that it doesn't scale. If the big banks are screaming about the costs and the regulatory compliance problems, the little guys it's 10 times worse. We're seeing that in the private equity space as well, where the big private equity funds can deal with all this SEC compliance, and the little ones are getting creamed. I mean, there really has to, with all big legislation, you have to go back and review it. I think if that ever does get reviewed, I think it's worthwhile to look at the scaling challenges of the smaller lenders and the smaller investors versus the largest, as far as how they can handle the compliance costs in the back end.
I think community banks should be exempted, but that's just my opinion. Mr. Bradshaw?
Yeah, and to your point, Chairman Rice, I mean, we're a large, my institution's a large community bank, and we're just under $10 billion. And in Dodd-Frank, going over $10 billion, there becomes essentially a regulatory tax. And so you don't go to $11 billion, you go from just under 10 to 14 or 15, because you have to pay for that additional cost. You just don't go right over it. And so it's a very real thing in our world.
I've spoken to community banker after community banker. Community bankers have come in here. The owner of the only minority-owned bank in Washington, D.C. was in here last year saying that if we can't find some relief for him, that Dodd-Frank will put him out of business. And I hear that over and over again, and access to capital is just so incredibly important. I worry that we really need to go back and review some of that. I yield to Mrs. Chu if you have any additional questions.
I do, and thank you, Mr. Chair. Mr. Bradshaw, last year the 7A program faced a funding shortfall, and Congress had to include a $1 billion allocation for the program in the continuing resolution to prevent the program from shutting down. For 2015, the 7A lending program is potentially facing another shutdown in a few months if loans continue to follow these projections. How critical is it for Congress to appropriate and authorize adequate funding for the program? And what would be a real-life example of what consequences there would be if there's a potential shutdown of the program?
Thank you, Congresswoman Chu. Yes, we feel that the program will run out of money this year. We talked about in my testimony that we think it's probably in August. And what that would mean in terms of real life is you could have a customer that you're working with. They're acquiring a business or a piece of real estate or both. They have a purchase and sale agreement. So they've committed hard money to this purchase and sale agreement, and we can't process their loan because we've run out of money with the SBA.
Thank you. Mr. Palmer, I certainly heartily support the idea of lifting the cap from $225 million to $350 million. And I understand there's also another issue which has to do with the licensing of the family of funds and that it's taking longer and longer. Could you talk about that issue and what needs to be done?
Sure. Thank you very much. The licensing process for the SBIC program is sort of the front line of taxpayer protection, in that if they're making sure that only qualified people are getting through, and those standards need to be high. However, the licensing process is really long, and this administration had actually did a very good job for several years getting that licensing process down to about 5 months. It's now, the official numbers are around 9 or 10 months. That doesn't include a month of the magic mailroom where the documents don't get processed and some other stuff. So it really is running over a year for repeat licensees. And for a repeat licensee, you're talking about someone who's raised a private capital, gotten licensed with the SBA, invested successfully, gone out to the market again several years later, raised private capital, has all the exams, been compliant, and then it's taking them another year, potentially even longer than it did the first time. That doesn't make any sense. And so they've got a process that the standards need to be high, but it's got this multi-tiered process that really can be consolidated and sped up and maintaining taxpayer protections that really right now is causing people's vein in their forehead to pop out out of frustration, but it's also slowing things down, adding costs, and there really isn't any benefit to it. That we'd really like to get that reformed, and I think probably the SBA would too. They just kind of need a little push to make it happen.
And it makes total sense to differentiate the repeat licensee versus the new one.
And I think there's an added benefit to that too, because if you put your resources to the first-time funds that are really more unknown, it gives you more opportunity to reach out to geographies that you haven't touched before or that you haven't done the outreach for. It also lets you do a deeper dive on the backgrounds of the people that are coming in, so you can get more diversity of fund managers that are coming in, because right now, they're treating everyone exactly the same, even if you've been on your 4th or 5th license, and dedicating those resources there, where you really have a whole new generation of investment managers in women and minorities and doing different strategies that really they can't get the time of day because they're not in such a tight band, and I don't think that helps the program or the country at large.
Mm-hmm. Mr. Napoli, you had a third reform that you were discussing, which is this 155th rule. And the SBA has requested to adjust this cap for the 155th rule in the 2016 budget request. Can you tell us what this is and what you think the adjustment should be on this?
Yeah. So currently there's a rule called the 155th rule, and what it means is that the amount of funding for lending for SBA micro-intermediaries is divided equally between 55 states and territories. That's the case even when several of those territories or states don't even have an intermediary actually located there, or a lot of times they don't even need that much actual lending capital, but other intermediaries do. And so what happens for the first 2 quarters or 6 months of the federal year, funds are just sitting at the SBA until they're able to open up to these other intermediaries in other states that actually have a demand that's been waiting for the last 6 months. What I believe it could look like is just to actually look at eliminating that altogether and allow for those intermediaries that actually have demand to show that, and for the SBA to make loans that are targeted to those intermediaries that make sense for the demand that they have.
Thank you. And if I could ask another question. It's about the SBA requesting a 30% increase in funding for the Microloan Intermediary Lending Authority. which would be expected to support about $75 million in loans to small business. Do you think this increase is enough for the level of demand that you encounter?
Well, as I stated, 88% of small businesses fall under micro. It's a huge amount of businesses, but I also know that that is a completely digestible demand that we can meet this next year. So yes, absolutely, that's something I think that I can come back in a year from now and show the amount of jobs created, the fact that we've gotten the money out, made quality loans, and then the next year pose the exact same good problem to have.
Thank you. I yield back.
Mr. Hanna.
Does anybody, Mr. Bradshaw, Mr. Palmer, we have a situation which I think Mr. Rice, Chairman Rice, rightly identified, and that is this kind of dragnet thing that Dodd-Frank did, caught up a lot of commercial banks that were doing just fine, added millions to their cost of doing overhead in small communities, increased their overhead, limited their ability to make local loans and do the things that you four do so well. So you, and I saw you nod your head, Mr. Bradshaw, you would eliminate at some point, maybe on a sliding scale, the requirement for commercial banks to fall under some of those rules or those. How would you change that? What would you do differently?
Well, I'm going to respectfully agree with Chairman Rice. I like the thought process of looking at the community banks first. And that, if you look at what we announced an acquisition about 30 days ago of a $1.3 billion bank, and in the press release, the CEO of that bank said one of the reasons he was selling was because the regulatory pressures were just too hard on it.
Yeah. Well, I guess what I'm suggesting implicitly, and Mr. Palmer or anybody, is that in doing that, we actually made it more necessary for the SBA to do all those things because we interrupted the marketplace in a place that arguably maybe we didn't need to or didn't need to do as much as we did. So the whole nature of loans from commercial banks has become more strict, more difficult, more onerous for people to go to. So therefore, you have more need for what you all do, which is it's good that you're filling the need, but maybe we can work up the food chain and down the food chain.
I'd like to comment that in a commercial loan environment, you do have a credit approval process, and I can tell you that the credit officers have not forgotten about 2007 and 2008. So I don't know that all the additional regulation is necessary in that regard.
Mr. Palmer?
Well, the SBICs, their growth in the SBICs has been driven by a couple things, but one of which is just the awareness of the SBIC program, and frankly, it has been run well. It really had some struggles in the late 2000s, before the financial crisis, just from some management issues, and very few licenses were getting out there. So as the SBIC product has become normalized, they've partnered with a lot of banks, which they'd done before to a certain degree, but not to the extent they do now. So they're backfilling and allowing banks to do lending that they otherwise couldn't do, because they're often coming in with subordinated debt where the bank comes in with the senior, but the condition of the business itself would not otherwise be eligible for a loan. So it really, they go hand in glove. But to your point, I do think we need a healthy banking structure generally, and let the banks, operate in an appropriate and prudent way to fill the market needs, and then where the gaps are, where public policy should be applied, let it be applied.
Sure, and if they're not allowed to assume any risk, then there's more and more demand on what you all do.
Well, the challenge there is a real perception, whether fair or unfair, in the market that the risk is trying to be completely stripped of every investment and every loan in the universe. And without downside risk, there can be no upside risk.
Right.
And I think at some point we need to establish what is the appropriate level of risk we're willing to live with as a society.
Which, Mr. Napoli, you probably speak to that better than anybody here since you do microloans. Do you think a lot of people could be successful that just don't fill the bill for you? Do you think there are opportunities out there to take a greater associated risk for microloans and ultimately grow what it is you're out to grow, and that's businesses and create jobs and all of that?
Absolutely. As I said before, one thing microlending does is definitely address the minority and women-owned markets better than any other lending tool. But one of the trends I see right now is the increase of younger entrepreneurs that isn't being addressed by the market. Talking about people coming out of college or even young 30s, and a lot of times these are held down by the amount of student loans they have. Is a huge factor, but I think that's one thing that we could definitely target and do a much better job.
Thank you. My time's expired again. Thank you, Chairman.
That was a great hearing. Thank you all for participating today. I truly appreciate you taking time out of your hectic schedules to provide the committee with suggestions for improving SBA's lending programs. These ideas will be instructive as the committee works to ensure small firms have access to capital, which is vital to their success and necessary for the United States' continued economic growth. I ask unanimous consent that members have 5 legislative days to submit statements and supporting materials for the record. Without objection so ordered, the hearing is now adjourned.